Timing the stock market sounds good. Invest when things are going well and get out when it's bad. But no one can predict what the market will do with consistency. So should you simply set it and forget it? Hey there, it's Alex and Anthony from 1 Degree Advisors. If you're new here, we are certified financial planners that help folks with all things tax, retirement, and investment related. Anthony, people love the idea of perfectly timing the market, but in reality, it's impossible to do with consistency. That's what the data shows. But investing and then never looking at your investments again is not a good idea either. Good investors are okay with the fact that we cannot perfectly time the market, but today we're going to discuss 5 solutions to consider instead of, again, trying to perfectly time the market.
Yeah, let's first show why timing the market is next to impossible. The lowest point in the market does not come with that all clear sign, like, hey, it's ready to go, because usually that's when the news is at its worst. Here's the front page of Yahoo Finance, March 23rd, 2020, right in the heart of COVID. At this point in time, the news was terrible. All the bad unemployment numbers were just starting to come out. No one was predicting that the market would bounce back from there. And in fact, the stock market returned 67% from that low point in time through the end of the year. And here we're going to put a chart up here to show you the full year 2020 and just how dramatic the decline and then the recovery were.
Okay, for people who are still not convinced, let's go through a couple reasons why timing the market is difficult and potentially harmful.
Yeah, number one is that you need to be right twice. Okay, it's great to get out, and sometimes people will brag about that, but we hear so often, well, I don't know when to get back in. Things are starting to recover. They're probably going to come back down again. I'm afraid to get back in. Yep. After 2008, this was a great example of it, because we heard it all the time, is you had that deep decline, starts to come back, and years later, the news was always talking about double dip recession. Mm-hmm. That was the terminology that the news was using.
Yeah, your neighbor got out a little bit before the dip, and then he kept telling you, see, I told you, and then it's 5, 6, 7 years later, and they're still sitting in cash. Right, and that in itself is very harmful and a problem.
Yeah, Greece was defaulting on their debt, and for years, the market was recovering in the midst of bad news. Here's the second thing, is that missing the best days in the market can be costly. I'm going to put up this chart here from DFA, and what it shows is that if someone had invested in the Russell 3000, it's a stock market index, $1,000 over a 25-year period from 97 to 2022, that $1,000 would grow to $10,367. Well, missing just the best week out of that time period would bring it down to $8,652. That's a dramatic decline for missing just the best week.
Yep.
I mean, take another example, the best 6 months. If you miss those best 6 months, it goes down to $6,700. You'll notice if you look at the graph here, all the dates that are shown for these best periods are right after dramatic declines. I mean, telling us that often the strongest part of the recovery is nearly after the bottom.
Yep. Okay, Anthony, so if we can't perfectly time the market, let's go through 5 solutions of what folks can do, especially during times of distress like we're seeing right now. The first solution here is diversification.
Yeah, I like the way that Nick Murray says it. He says, diversification is the conscious choice not to make a killing in return for the blessing of never getting killed. It's about spreading your risk.
Yeah. And the second thing here is inside of your portfolio, including like a tactical / trend risk management strategy.
Right. It's a way to diversify your risk management from just bonds or cash using a data-driven strategy.
Now, so far this year, our trend following tactical strategy has worked really well. So a lot of folks are like, well, why don't we put, more of our portfolio in this? And of course, we have to remind them with discipline, there's a reason why it's just a piece and not the whole pie, because when there's a clear trend down or clear trend up, this strategy works really good. But when things get choppy and there's no clear trends, it won't look that great. Right. The third thing here is rebalancing your portfolio.
Markets cycle up and down. It's getting back to your target position so that you can optimize risk and return.
The other thing that folks can do this year, especially with markets down, is look at tax loss harvesting, especially if you have like a taxable brokerage account. You can also look at repositioning some holdings that maybe you've never really wanted, but now could be a good time to do so.
Yeah, use the market to your advantage. If you have some positions with losses, maybe selling something, moving it into something similar so you can still participate in the recovery.
And then the last thing here is focus on stabilizing your income.
Yeah, they could be direct income sources like Social Security, rental income, pensions, but also having enough in short-term conservative investments so you can take income from that and wait out the stock market.
Again, the main thing here is focus on the things that you can control.
Yeah.
Nobody can perfectly time the market with consistency, but with a good plan and following these basic principles, you can set yourself up for long-term success. Once again, this is Alex Okagawa from 1 Degree Advisors. And if you're interested in learning how we help our clients, especially retirees, develop an investment plan for both the up and down markets, visit our website at onedegreeadvisors.com.